Hey there, welcome to the closing bell. I'm recording this on the 20th of September, the week that the Fed has come out and cut rates by 50 basis points. A big cut to kick things off. Market was pretty much predicting it at the time. I wasn't sure it would happen, but there you go. They really started out saying they want to cut it dramatically, which means, what are they seeing out there? Are they seeing things slowing down more rapidly? Are they a bit worried about what's actually going on beneath the surface? Um, the markets, jumped to attention, and we're seeing property stocks flying at the moment. A bit of a recovery in those things after being beaten up. Also, we're going to, today I'll look at the US dollar as well. That really is on the edge. I've been saying for the last few weeks. I gave you a bit of a presentation on the Aussie dollar and the relationship between interest rates and how it really is a very high correlation between the way the Aussie dollar moves and the difference between Australian and US interest rates. So that was saying that the Aussie dollar is probably on the cusp of a run, and it is actually starting to run after what happened today. So this is all stuff you have to be thinking about, how it's going to affect the companies you're exposed to. Are we going to see, oil, copper, etc., start to pick up if the US dollar cracks 100? So a lot of things to think about at the moment. And I wanted to start with looking at one thing in particular, which is just, I guess, keeping me up at night when I think about the S&P 500 and that it's blasting off. This is just a line chart showing you a monthly chart of the S&P 500, just giving you a sense of that rally from 2009. This has been going on a long time, hasn't it? This rally really flying to the upside at the moment. And actually, they cut rates with stocks at all-time highs, which is pretty interesting. So I'm just aware that you got to go with it when it's trending really strongly. All well and good. You got to go with the trend and the flow and say, right, well, I need to see it sell off before I get too worried. But the one thing that makes me sort of fearful that we're in some sort of a blow-off phase, which can then reverse pretty quickly, is looking at the central bank balance sheets and how they've been moving, the very high correlation between the world's major central banks' balance sheets, the size of their balance sheets since the crash in 08, 09, and the very high correlation to the S&P 500, which has been really quite amazing. And that has broken down recently. So central bank balance sheets have actually been falling, but we've had this big blast off. So it's only recently that we've seen a really big breakdown. So I just want to show you um, the actual central bank balance sheet chart. So we'll just bring that up. If I just do this. So this is the chart of the major central bank total assets. And you'll see from this '08 area, when we had the crash, we've had that rocketing higher of the central bank balance sheets. And what I want you to note is the periods of rising strongly, periods of sideways, periods of rising, periods of sideways, periods of rising, periods of sideways, periods of rising. Now, if I just flick back to that chart and we have a look at the way it's moved, can you see that relationship that has been very, very high correlation, where it's been very similar in the way it's moved? The periods of central bank balance sheets increasing, periods when they flatlined, periods when they're increasing, and then we've got this period where they're coming off the boil. And again, I'll flick back to the chart so you can see it. And the way that relationship, as you can see there, you can even see it pretty closely, that it is tracking it, the picture that I've showed you. And we've got this period where you can see central bank balance sheets pretty much steadily trending down here since the peak in February 22. And that was actually the peak that we've got here. So this sort of predicted all of this, but then we've actually had it continuing down. And at the moment, we've got stocks have just completely ignored that and are blasting off higher. So I guess what I'm wondering is this some sort of blow off which will ultimately come back to earth? And if growth really does come off the boil, if the Fed is actually worried, and we're going to see things move into even recessionary conditions, you know, it may go something like that. So I just want you to be aware, I'm still open to seeing this. If sort of after they do the first rate cut, you can have this big buying binge that goes on, and then the music can stop and it could turn down. So it's just a story for another day, but just you want to have that in the back of your mind, um, that sort of mismatch that's going on at the moment between those central bank balance sheets and what that S&P is doing. Moving on to the ASX 200, all breaking out and looking fabulous on the monthly chart. I've been saying for a while it's in long-term uptrend. So, sorry, this may look a bit confusing. I'm going to explain it all to you in a minute, what's going on here. But just noting the moving averages, 10-month exponential, well above the 20-month simple, and monthly bars marching higher and, finding support where you'd want it to. I've been sort of saying it needed to hold above 7,500. And on the recent correction, it sort of went and hit that level and then has bounced off. So for the moment, everything is pointing up and it's looking good. But I'm always sort of looking ahead and saying, well, where could there be trouble ahead? So for the moment, it's all systems go, and I'm actually starting to buy a few things and going with this, saying, let's see how far this trend can go. You've got to go with the trend, but I'm just looking at these corrections, and I've been showing you how there can be a relationship between these corrections, and then it can sort of rally out of the correction, but there's an area outside the range where it can be sort of a danger spot, I guess. And what I'm saying there is if I calculate this big correction, which happened in 2011 to 2012, and I'm just looking at the areas outside that range based on, the length of the range. So like 25% outside is one area, and then the major one is the Fibonacci level, the 61.8. That blue line is the major one I want you to think about. It's just an area where you've got to be sort of careful that it could actually peak out there and find some selling pressure. And that's when everyone's bullish and it all looks like it's trending higher. This is when it's rallying like this is when everyone's just getting long and bullish and it's never going to go down. And that's just the area where I sort of go, well, watch out here. If it does turn down, you can have a bit of a correction. So I just wanted to follow along. If I'm then making the calculation on this correction, which happened from 2015, 2016, big correction there. So I'm looking at that range and then looking at the area 25% above and the 618 above. That's the area where I just say, well, watch out. You could see a reversal from there. And if you see what happened, prices recovered. They broke out to the upside. Look at that there, hit that 25% above level exactly and sold off. Where did it sell off to? The point of control, the midpoint, exactly. But then rallied again, another big rally for a year or so. But here's that level, that blue line, the 618 above the range, where you say, well, just be a bit careful here. If it does turn down, it could have a correction. And that's actually where the 2020 crash happened from. So I'm just looking at the correction that we've had over the past few years in 2022. So you've had that big sell-off And now we've been really stuffing around so much, haven't we, for the past year or two? It's been a pretty difficult time, but slowly trending higher. And now it's sort of in that phase of breaking out and looking fabulous. And it's heading up towards that 618 level. So that's just, for me, it's not somewhere where I just sell and get short. It's just saying that you're aware. So if this just keeps trending, beautiful. That's what we want. We want this market to now really break out and trend. Just trust that long-term trend, and that could definitely happen. Uh, but just saying if it does do this and then we have a bit of weakness, I get a sell signal from there. That's what I'm just a bit wary. That's the only point is saying this is sort of an area where everyone's bullish. It all looks fantastic, but it is actually a resistance zone above a very major correction. So that's just the area that my model picks out as being, well, it can actually peak around that level and have a correction. So having said all of that, it's still all positive. Long-term uptrend, all good. Let's cross our fingers that, that's ignored and the market just manages to really run into the end of the year and prove that it really is a good, strong bull market that we're in. And we're thinking about that US dollar, and I'll just jump to the Aussie dollar to give you a sense where we're at. So this being the Aussie dollar over the past few years from 2020, I'm looking at the range that it had from 2020, 2021, going from, 55 cents or so up to 80 cents, and just analyzing the price action since based on that. You'll see the midpoint, the point of control here at around this sort of 67 and a half, 68 cent region. So we've, had a bit of resistance in that sell zone area. It's collapsed, had a big sell-off. Where did it go? The buy zone. And then it's really just been oscillating around this point of control, hasn't it? So this 68 cent region, it hasn't really been able to get above it for what, a year or more. It's had a few goes. But now, 2 weeks ago, it was down here when I gave you the video saying, we could be on the cusp of a Aussie dollar rally. And here it is sort of knocking on the door of the resistance, which would sort of prove it's breaking out above this point of control, this very important level. So it's sort of set up to have a bit of a cascading effect, I guess. We could see quite a strong rally, and that would be if the US dollar was also really dumping. And that could be, look, leading to also commodities picking up. I'm seeing aluminium looking pretty good. Also zinc, I think, and oil also actually sort of being supported. I'm saying, I've been watching oil thinking it could really collapse, but it's with this US dollar turning down, maybe that will save it. So let's have a look at oil. So on this weekly chart, oil's still pretty weak, and on the monthly also, we know this area, this sort of $70 zone below there, it's sort of a bit sketchy. It's gone down and tested it just last week. And this is what these false breaks are like, where, testing where the stop losses are. And also the positioning was quite negative, and now we're having a bit of a short squeeze. So is this the beginning, of things turning around if that US dollar really starts to sell off? It could do. That's sort of how these things happen. But, you've got your eye on those lows. If world growth is really in trouble, if China is really turning down with that property market in trouble, we'll see the resistance hit, and then it could go for another wave to the downside. So back below those lows, sort of below $70, $69, whatever that low was, you are wary that it could be in for a bit of a sell-off, because I think there would still be quite a few stop losses in this zone from people who have been, getting long the last year or two in that area. So it is danger below there, but it's sort of interesting that we're having this false break of the low. Ultimately, I'm bullish oil prices long term. So, always waiting and watching when we're going to get a nice buy signal. So, let's see whether things can hold in there now and start looking a bit more constructive. But I'd probably wait for that weekly trend to turn before getting too excited. But also, copper starting to pick up. Copper still quite strong compared to most commodities. We know that big picture. It is actually in long-term uptrend, one of the few that is in long-term uptrend. This is a monthly chart. We recently saw a new all-time high. So big picture, still looking pretty good and trending to the upside. And if I'm looking at the way it's been rallying for the last year or two, I'll just go in a bit closer. I'm just wondering whether this current trending motion is going to continue. And that's sort of looking at the way it's rallied and corrected over the past few years. So we've got this next wave to the upside, and I'm looking at that wave and thinking, well, if it's strong, as I've said before, this buy zone area of that wave uh, should see uh, it turn back up because we've had a correction back to those moving averages. You can see buying pressure coming in there. And this month, potentially, we're going to see a monthly buy pivot within the long-term uptrend that's in place. So that's, actually, a buy signal in a long-term trend when you see that sort of thing happening. I can show you, find one for you. Let's say with this trend, we had a correction after a rally, monthly sell pivot there, sold off back to the moving averages, and then we've got the monthly buy pivot coming in there. So it's a long-term uptrend, monthly buy pivot comes into play, closing back above the 10-month moving average, and there's your next wave to the upside. So that's sort of how I'm looking at this. Still big picture, thinking that anything can happen due to the weakness going on. But big picture, long term, want to be getting long copper for the breakout above the all-time high. So, this one may not work, and then it has another correction, and then that one works, turns up. So that's all possible. But just letting you know, with US dollar weak, it's seeing some buying pressure into copper, and that could send a little buy signal at the end of this month. So it's a similar thing in a few of the other commodities like aluminium. So it's sort of wondering, is this getting towards some sort of nadir in this commodity cycle as rates get cut? And that's where some opportunities will lie because it's been a real bloodbath in that commodity space, hasn't it? And we know long-term, big picture, we want to be in that space for the energy transition. So the opportunities in these shakeouts is what we're looking for. So that's the sort of thing I'd be looking at, as well as I've shown you in the property space. Just to give you a sense of the moves happening in the property, good yield. They've been hit pretty hard, all those fears of office properties, people working from home, loss of value, a lot of them trading, 0.6, 0.7 of book value. With rates coming down, the things start ameliorating. We're hearing that there's people asking, Tabcorp telling people go back to the office 5 days a week. Are we going to start to see a bit more movement in the city? Things are in recovery mode. So there's a bit of buying coming in. Here we have Growth Point Properties, GOZ. Just again, always looking out for these big retracements, clear outs, and knowing there's stop losses going off when prices collapse below those major levels. And then you're looking for signs of things turning around. And, we're seeing that we've got monthly buy pivot there, new key bars marching higher, long-term trend about to shift. And we're seeing that sort of buying pressure coming in, aren't we? Like the false break of that level, and then you're sort of expecting some sort of mean reversion to happen based on, if I just look at this wave to the downside here, you'd be expecting a move back towards sort of 325, where I'd be taking part profit, that sort of thing. So if I was looking at one of those sort of businesses and thinking about them, Charter Hall's really taken off, kicking myself on that because I got on it. And then we dumped it for a few percent loss when I got a bit nervous with inflation kicking higher. And now it's flying up like a rocket, making it hard to get on. CLW as well, Charter Hall, long whale REIT. This is sort of long, good customers leasing out property and very long-term leases, that sort of thing, stable, etc., etc. But they've gone through a big problem, haven't they? A major low there from 2020 crash, a big clear out of positions below there. We've already had one wave to the upside and a correction, and now we're seeing the bust out, the breakout, and the long-term trend shift on the cards. So that's all similar across the board. URW as well, actually in long-term uptrend, possible monthly buy pivot this month. National Storage REIT, all of these are going to have pretty good yield. It's been going sideways for years. Possibly that's ready now to trend higher again. Long-term uptrend shift there. GPT Group also really turning higher. It's running pretty hard. Maybe a bit late to the party here for the moment and could buy it closer to the moving averages on a correction as the long-term trend heads higher. But that, you can see it's an across-the-board thing going on. TCL, though, not getting as much love, or APA, Australian Pipeline Trust. Maybe that's going to be an opportunity at some point. But Mirvac Group turning up as well. Monthly buy pivot a couple of months ago. Possible long-term trend shift. It really has been stuffing around for a while. But we may be at the time where it can start to recover. Doesn't look as great as the other ones. Vicinity centres starting to really rocket now. That's been caught for a long time in this range, $1.70 to $2.10, just sort of on a breakout and long-term trend. So that property exposure as rates fall looks like that could have some legs in it, and a good way to get some solid yield. So that's sort of what I'm looking at the moment, having a think about. Let's see what the Aussie dollar does, whether it really starts to spike. That might be your interest in looking for a trade. And yes, can it help this commodity complex recover? So things are interesting out there with rates going down. Time to start paying attention. All right, cheers. I'll come back with more next week.